90s networking, which I've never experienced. So
Yeah.
Those higher level masterminds tend to come with a hefty price tag at times, but people.
Yeah.
Do you disagree?
All right, everyone. Thank you very much for tuning in. Today we have our very first guest, and we wanted to start out with a bang. So we brought on Ontario's own Kellan James. So welcome to the Refined Real Estate Podcast. We have like a weekly meetup where we review podcasts. And of course, we're in Rise, we're in Andrew Hines, all those good ones. So we've actually had you come up a number of times. So we got to hear your story from when you first bought, I think it was 23 units on Andrew Hines, and then you were up to about 54 units on Rise. And we've heard your story a few different times along the way. Cool. Now we're here to sort of bring it full circle. So maybe if we could start, let's hear about how you got started in real estate and sort of where you've grown with that.
Yeah, for sure. So I go by Kellan James. I started in investing in London in 2016. Before that, I worked in the tech world. I actually never made it more than 80 grand at my day job. So that was the salary cap that I kind of hit towards the end. Most of the time I was making 50 or 60. And I just saved every penny I could for about 4 years or something like that. I think I saved about somewhere between 100 and 120 grand. I can't remember exactly. And I took that money and I ended up buying my first duplex. So I was kind of looking for financial independence, and I was looking at Mr. Money Mustache and some of these guys that do financial independence through, index fund investing and things like that. And then I was like, okay, well, and I was looking at that, and I was actually starting down that path. And I was like, well, at least that gives me an out in like 13 years or something. Like there is a way that I don't have to be at this day job forever. And because it was never really my passion, it was sort of a means to an end with get a job that's half decent, computer science at school, and then get a job that's half decent income. And so then I bought my first duplex in 2016. I did 5% down. I should have done a purchase plus improvements mortgage on it. So anyone who's starting out now, that's one of the best ways I think to start. 5% down, purchase plus improvements, get your renovation money back. Banks like Scotiabank work really well for that. There are others that'll do it as well. And so I lived in one half rent. It was a very classic story, but I guess it's because it was a little bit back. And that was sort of when people were starting to kind of do this. So I lived in one half, rented the other, and then renovated it myself, moved into the other side, did the same thing on that side. And then shortly after, bought my second and third property, and they actually closed on the same day. Those were, of course, everything from there on, it was at least 20% down. Luckily, I had a decent amount of savings, so I was able to tackle those couple. And then one of them ended up being a fantastic burr. I got all my money out and more. The other one, I got a good chunk of my money out, but not all of it, which is totally fine. It's actually the house I'm living in right now still. So it's a triplex. And so I'm still house hacking to this day. And the journey kind of goes on from there, but I guess I'll let you guys kind of direct what you'd like to hear from there.
Yeah. So again, I was listening to people like you that I actually learned about like the value or the purchase plus improvements. So that's actually what I did on my very first house, 5% down.
Awesome.
And then I at the time, and still to this day, I own Refined Roofing, which is like a construction company. And we actually were able to have my company do the work. And
perfect.
So, I got about 20,000 in mortgage plus improvements, hired my company for $20,000 to put a new roof on and a few other things. And what ended up only costing me maybe $5,000 out of pocket, I got about 15 grand back. So my down payment out of pocket was, couple grand. So
beautiful. Yeah. That's the way to do it. It's an amazing way to get momentum early on, get familiar with what it's like to be a landlord, close on a deal, just break the ice on everything, and still have enough capital to move on to the next deal. And then that one's 20%, and then it's more of a typical burr type scenarios from there. But that's such a great way to start. I've been kind of trying to drive that home for people for a lot of years. So I'm glad that worked out well for you.
Yeah, no, absolutely. And again, thank you guys so much. Like people like you sharing your story. It's like, that's where we're learning this stuff. It's not like we're, just like talking to these crazy gurus out in, the middle of Texas or something like that. It's literally listening to people that are just, you guys, are your few provinces over, but we're playing under similar rules when it comes to the real estate side of things. So,
and same here, right? Like when I was starting out, I was like, I'm going to do 20% down, maybe more, because it'll lower my mortgage payment. And then Matt McKeever was like, hey, maybe instead you should do 5% down, and also you can pull money out of your RSP using the home buyers plan and like all these things. So I was like, I wouldn't have been doing this stuff had I not had a mentor myself. So, and then when I got into the BRRRRs, it was like, hey, maybe don't over improve on these renovations. Here's how to approach it strategically. And I was planning on, gutting everything and starting. And he was like, no, you can actually keep that. You can do this. And the numbers ended up working out so much better on that renovation and on that BRRRR because of that, which gave me the momentum to take on the next deals and get better and better at that. So, having that guidance is the only way. We're not learning this. We're not just pulling out of our asses. Like, we're learning it from other people or from, free online content or a mentor or whatever it may be. But we need guidance one way or another.
Oh, absolutely. And then from doing some research on that, listening to some of the other resources that you had. So I know you said you were deep in on Bigger Pockets, and that's definitely something I'd say I've probably listened to pretty much every single Bigger Pockets back in the day. Oh yeah. Less so now, but like in the early stages, definitely like back when it was like Brandon Turner and Josh Joykin doing Bigger Pockets, like going from that and then getting into what I consider the golden age of Bigger Pockets, which was David and Brandon, like all their podcasts. Like I still go back and listen to them. They're my favorite. The new ones are still good, but Bigger Pockets nerd.
I think I only did about 100 episodes from the beginning. So I honestly maybe didn't. I should go back and listen to more, but I've had some people there's certain episodes they've listened to over and over again. And I'd love to hear actually people's recommendations on that stuff, because it's been a bit since I've been listening to podcasts. At some point I kind of switched from more the consumption side, more to the production side on in terms of like putting out content and stuff. But that being said, like I've noticed recently a lack of mentorship in my life. And it was such a big thing that helped me to get to where I'm at. And I really need to bring more of that back in at this point, because at this point, it's a lot of teaching and showing people, but not a lot of when I'm stuck in a situation, it's kind of just me. And I remember that was sort of we've all experienced that at some point in our first job or second job or whatever, where I have a problem. It's like, this is my problem to solve. This isn't like, I can't just go to the whoever and they'll tell me. It's like, no, this is my problem. So same thing now, if I'm looking at my portfolio, trying to figure out how to optimize it, there's only so many people at this point that I can talk to, that I can kind of help me restructure things. But they're clearly out there. So I need to make more of an effort to bring those people into my life so I can be the idiot, the idiot in the room or whatever, and just learn as much as I can.
Yeah, me and Ian are big proponents of mentorship on all levels. It accelerates growth significantly. And one thing, Kellan, when I first started getting into real estate, like you guys, Bigger Pockets guy, but it's all American based, right? So I was like, I need to find something in Canada. And that's where I came across you, Matt McKeever, all these Ontario guys, Colton Lukey, Dylan McLaughlin, like all this little crew of people. And this brought me to networking with guys like yourself. And it just takes off from there, I just wanted to say, really appreciate the content that you created along your journey. And that's kind of why me and Ian and Janelle started this podcast, because we're like, all right, the next generation, I want them to come across stuff like this so we can help them.
100%. And honestly, it's nice to hear those reminders, because I think a lot of people who are putting all this content out there, they don't actually realize the impact that they're having. So every once in a while I hear that hey, I listened to your podcast some years ago. I took action on it. This is what I've done. And I don't know, it's so awesome to hear that stuff. Cause I never really thought of it that way. I was always just trying to help, put out information. And, for years and years and years, I had zero asks at all. I started up my own mentorship at this point, but that's it still to this point. It's just been all just give out information. The reason is I found the law of reciprocity and just karma in general to be such a powerful thing. So just putting out great things, helping people the best I can. And then I find they tend to help back, and I end up building good connections, getting, great networking out of it. And also when you're you guys, you've started on your own podcast here, kind of being the hub to things really makes a big difference as well. We had like local meetup groups like London on Fire, things like that. And like, yeah, just being the hub of things makes a big difference versus just attending things. So we talked a lot about that in the earlier On Fire podcast episodes. Like, if your city doesn't have a meetup, start your own. Now every city has their own meetup, like I think for the most part, but it's awesome to see that people have taken action on this stuff.
Oh, big time. And we've actually taken a page out of that book. And for the last probably 6-8 months, we've been hosting some of the in-person meetups.
Awesome.
There's some other groups around doing it, but it's more so let's bring in a keynote speaker, a mortgage broker, an industry professional. Whereas ours is purely like, let's grab a drink. Let's just chat with people in the room, share some ideas, share some contacts, and just make it a little more fun. So
it's the grassroots networking is where it's at for sure. I mean, like there is value in high level masterminds, but it's hard to find higher level masterminds. Like there's there's still a lot of newbies coming out and stuff. But if you're like at a medium, an intermediate stage or you're becoming an expert, it's hard to find higher level masterminds. In fact, most of the time, you kind of just get reached out to at that point. It's not actually a lot of public stuff, but when you can put out that stuff and bring people around that are at your level or above and people that are below that you can teach, it's just, and having that grassroots, just get together, have a drink, everyone can talk. And I think there is maybe some degree of balance with like some form of structure as well. But like the point is definitely to get conversations going and not just, here's a mortgage broker, here's a lawyer, whatever, like that stuff. That brings it back to like, the 90s networking, which I've never experienced. So
Those higher level masterminds tend to come with a hefty price tag at times, but people. Do you disagree?
Like there are like, if you reach out to right now, if you reached out to people who are at your level and just said, hey, let's get 5 or 10 of us together. I'll host it at my house. Let's all talk about our biggest issues right now. Let's be completely open and honest about what our challenges are. You now have a high level mastermind, at least like at whatever level you're at. So like I do that with some of my friends at this point, it's just, we just get together and we alternate houses. So like, and we've done some other stuff that's a little bit like higher level as well, where we try and get more people in that are like, that we can learn from as well. It tends to be a little more difficult because you need to make sure you're providing value to them as well, and vice versa. It's the same reason I'm not going out to meetups as much. Like I want to make sure that I'm learning as well. So, but same idea. Like you guys have taken the action on starting the podcast. Like you can start high level masterminds for yourself. They don't need to cost anything. In fact, they probably shouldn't if the goal is to get people out at your level or higher. I mean, they're bringing value. So it's sort of just like, it doesn't need to be overcomplicated. It really doesn't.
No, that makes sense. So, all right, well, let's fast forward in your story a little bit. What's going on today? What's sort of your day-to-day looking like, and what's the portfolio consist of?
So the story kind of continued on for me from, I ended up getting up to 10 properties solely owned with no partners. And that was when I quit my day job. That was 2019. At that point, we took a van trip. My now fiance and I, we took a van trip. We converted a Sprinter van, traveled around the US for 3 months, and then came back and I was like, okay, how do I scale from here? Because even the first 10, like it started to get, it gets difficult toward the end to try and get more mortgages. You have to make sure the portfolio you have cash flows well enough that the bank continues to offer financing, and you have to work with the right people. Because there's, I worked with Scotiabank, but if you don't work with the right people at Scotiabank, they're still going to say no. So, working with lenders, just getting through the no's and finding the yes. But after the 10th property, I stumbled through a couple of different random lenders. And then I came across credit unions, and credit unions have been since exclusively who I work with. I'm open to other ideas and other commercial lending and things like that. But for the most part, like commercial CMHC financing and stuff isn't actually particularly interesting to me. It seems for the most part, like most people, I would say like 80 to 90% of people talking about that haven't actually done it or haven't followed through on it from beginning to end at this point. So I think it's a little bit, I think it doesn't apply to most people. It probably, if anything, applies to buildings that are completely stabilized. You have no intention of accessing equity for the next 5 years or plus, but credit unions and things like that, they offer a lot more flexibility because maybe 2-3 years down the line, you want to access some equity or you want to restructure things or whatever. And, being locked into like some of these commercial loans can get messy. But I ended up scaling up from there to, at this point, I have 86 units and still no partners at all. So it's just me. I do use a corporate structure, but I'm the only shareholder. So it's just me still. And I think that, like, you know, obviously people wonder, like, how does that happen? And, you know, the first 10 to 12 or maybe like 10 or so was like very, very little other people's money. It was basically banks and burring, you know, like people really, I mean, it's, you know, we talked about burring in 2016 and then everyone kind of forgot and they've just been talking about all these other things that are happening in the real estate world. But like burring is, in my opinion, still where it's at, you know, building a long-term investment portfolio for long-term wealth. And there's lots of ways to make more money quickly now, but like in terms of long-term wealth, I think it's still the way to go. So, you know, becoming an expert at that specifically becomes really important. And so those first 10 or so was barely any private money, you know, in terms of like borrowing down payment type money. It has since bled into more like bringing in some other people's money to help finance properties. But for the most part, I don't think that's a really good strategy to scale up to any crazy degree either. I think a lot of people really don't know what it looks like to unwind that debt. And that's actually what I've been doing this last, you know, so in 2021, I sold 5 buildings, which was 15 units, and I bought 51 units. And so that was a higher leverage year, right? So I've taken on a lot more debt. The buildings didn't cash flow very well because, of course, I just bought them. I had to add value still and turn units over. So since then, I've been in a stabilization phase, which I've gone through a few of over the years, where I'll go 12 months without buying anything. And the last bit, as part of the stabilization phase, has been paying off a bunch of private loans and restabilizing and deleveraging in that regard. And I don't think people know what that is like. I really don't think a lot of people have gone through that process. I think a lot of people are borrowing from Peter to pay Paul. And I think I don't think people understand how that plays out. I mean, we're seeing a bit to some degree how that plays out with there's some bankruptcies and things out there. So
Bernie Madoff. That's how it works out. Just a giant Ponzi scheme.
Yeah, and a lot of listeners will know we've seen local examples as well in Ontario and in other places in Canada and things like that as well. So I really urge people who are borrowing large amounts of private debt to really keep an eye on what that looks like and make sure that you have a plan to pay it out. And it's not just, I'm going to keep borrowing, because like the deals need to make enough sense that you need to add enough value in the deals to be able to pay people out in the long run. So that's what I've been doing, is unwinding that debt. I'm actually getting to almost very, very little, I would say, by in the coming 6 months or something. My goal is to get to almost none.
Yeah. And
just mortgage debt and no partners and have things in a very stable position. And having that foundation, Alex Hormozy's everywhere, and I'm loving his content too. And he's talking about, if you want to build a tall building, you need to build the foundation differently. And he says that, and I've been saying something similar for a lot of years, but basically, like, you have to build the foundation as you go. It's not like you can just constantly scale. You need to take time to restabilize the foundation before you build up further. So I think a lot of people need to take that stabilization phase, understand that you don't want to get too over leveraged, and find a way to scale safely.
This is amazing. This is a good, next week we're doing a podcast specifically on OPM and just everything around it. So everything you just touched on there, we're going to expand on that for 30 minutes next week. But that's great stuff, because I couldn't agree more. When you're using other people's money, there's other risks involved, and you need to have all kinds of exit plans. Like, you can't, if it's your own money, it's one thing, you can take your time. There's no rush. But
I think people, they'll look at a deal and go, I don't know how much sense this makes, but if I bring on a partner, it makes sense. But if I borrow money, it makes sense. It's like, man, the deal has to make sense. Like, it has to make sense on its own. Otherwise, how are you going to pay out the people, or how are you going to make money for your partner? And I don't know. So I think and the reality of it is, and this is like, the reality of it is, if the deal does make sense, there's a pretty decent chance you can take it on your own. Maybe you do have to borrow some degree of private debt for a short period of time, but with a plan to pay it out, in 6, 12, 24 months, but a very clear plan. And as we've seen when markets change, that can be more difficult to do. Even for myself, like refinancing in the last while, you get really crappy loan to values. You used to get 75% with a credit union. Now you get 50 to 60%. So you end up pulling out a lot less equity than you expect to. So then you end up having to sell. Like I sold a couple properties just to like deleverage, right? I've sell a property. I got 200 or 300 grand of equity that I can take and just plop and pay off a bunch of private debt. I mean, it's just like, it simplifies a lot of things. It sucks because you don't really want to sell stuff along the way, but and I could always just kick the can down the road and do what a lot of people are doing. But I really think it's important when you don't know where a market's going to go to prepare for both scenarios. So maybe we end up in a scenario where things boom again at some point. Great, we still have a portfolio to that can act, that inflation will act upon. Fantastic. But if it doesn't, or things get worse, or things stay here for a long time, it can't just be, you can't be sitting in a burn rate for years and years, or not have a plan to get out of this scenario unless the market gets out of it for you.
Yeah, and I'd be worried to think about just some of the sleepless nights, some of the people that got in it 2 years ago, scaled up really quickly, and just assumed that the market's appreciation, natural appreciation, was going to pull them out of whatever hole that they got themselves into.
Yeah.
And here they are left holding a massive bag. So,
well, Bank of Canada said, nope.
What's that?
So the Bank of Canada put a
cramp
exactly on all that.
They're hitting the brakes. Yeah, I was going to say something, but I forgot.
Yeah. Okay, so let's move on to maybe some advice that you would give for some people. So again, you did a lot of burrs out the gate. You got to ride that nice wave of natural appreciation up, and you had some pretty nice interest rates to do so. In the changing market, would you change your strategy, or what advice would you give to people that are coming into the real estate world now?
Yeah, you have to change your strategy. It's a different game. Like we were talking before this podcast started, like, you have to view everything like a board game. And if you're playing a different board game, like a different market, or like different geographic market, or a different market state, then you need to play. You have a different set of rules you're playing under now, and you need to come up with a new strategy. So in this market, you need to expect that loan to values on a refinance aren't going to be as exciting as you want them to be. You need to expect that cash flow is probably it won't be as exciting as it was because rates are higher. So it's really important now to identify what is a good deal, because I think a lot of people are waiting when the right deal comes along. If you're in a situation where you have liquidity right now, or you have an opportunity to scale that is in a, not over leveraging or in a safe manner, then you need to identify what a good deal is. Because if you're just waiting for the right deal to fall on your plate, you don't know, it might fall on your plate, but you don't even recognize that it's a deal. Because the reality is, it's going to be very difficult to get a perfect burr at this point. It's going to be very difficult to get something that cash flows really well at this point. So, maybe to some degree, a good deal doesn't have those two things, but maybe it has the ability to buy something significantly under market value and significantly under last year's market value. And you have the opportunity for, to own a great asset that you otherwise may not have been able to purchase in the past. And you look at it long-term. The only way to look at real estate is long-term. And people touch upon this, but they don't really take it to heart. If you're buying a building, ideally it should be a building you're willing and happy to own for the next 20 years, because for the next 5 years, the deal may end up not making that much sense. I'm not saying buy something that's you want it to make sense over the next 5 years, but if something happens, you want to make sure that you can hold. If you're an index fund investor, that when the market goes down, you don't sell. When the market goes down, you ride it through and the market recovers. And real estate's the same thing. It might just take a different amount of time, So you want to make sure that you're always in a situation where you can ride through, and that's where cash flow comes in. Luckily, for the most part, most people who have a portfolio right now, and they've kind of gotten through what we've gotten through so far, I think most people at that point will probably be all right, as long as they're not dealing with a very significant burn rate at this point. If they are, then I would consider deleveraging to some degree. Maybe that involves selling one of your buildings. If it's not that big a deal. I think that it's really important to bear in mind peace of mind with all of your acquisitions. So you don't want to take on a deal or if it's a flip or a wholesale or a buy and hold where you can't sleep at night. So you want to make sure, and I think gut comes into play quite significantly when you're talking about how much should one leverage and what is a good deal. Your gut will kind of kind of help there, especially as it gets more trained over the, through more experience with previous deals.
Yeah. So maybe let's dive into that a little bit further as well. So what are some of the metrics that you're using when analyzing if it's a good deal or not? Is it mostly just like price per unit? Are you looking at, debt service ratios, cash flow? What's some of the ones that you typically are using?
For the most part, when I'm looking at a deal, it's going to be, what does the BRRRR calculation look like, and what does the cash flow look like once the dust is settled on the deal? So at this point, you definitely want to make sure that when the dust is settled and you've finished your refinance, that the property at least, is going to cash flow positive with current interest rates. I think that would be a pretty decent situation. Like, if interest rates happen to go up further from here, you can't imagine that they'd go up too much further. So if they did, you might burn a little bit, but it's not the big, if you have a building, there's a lot of people out there that right now that probably have a building that's, losing $500 a month. I wouldn't say those people need to constantly have trouble sleeping at night, because that's $6,000 a year. There's a decent chance you're doing some kind of active income as well. And if you're not, you probably should be during a time like this. And that's a decent way to ride through things, So yeah, BRRRR calculation. I think that's one thing that hasn't changed, is that you still need to do your BRRRR calculation and you need to do your cash flow calculations. What has changed is that interest rates are different, so your cash flow calculations are going to be more difficult. And interest rates have changed, which also affects your BRRRR calculation, because the loan to values on the refinance are gonna suck. So really understand what the lender you're working with, how they do their calculations. That's another thing that hasn't changed. But what has changed is the math they're doing. So just understand, as of today, how are banks doing their calculations, and you'll be a lot more clear when it comes to what the refinance looks like in the end, rather than assuming you'll get 75% loan to value on a refinance. Because like I said, most lenders aren't gonna give you that right now unless the property's got fantastic income.
Yeah.
This might be an obvious question, but do you still aim to refi out all of the invested capital? Like, if you have to leave some money in the deal, what do you think?
There's been, I would say only 40% of my properties would have been perfect BRRRRs within, a year or a year and a half. Like, most of them, would be, you pull out a significant amount of equity, and you end up leaving some money in the deal. It's just the reality of things. I mean, sometimes you end up with a deal where you pull all your money out and more, and that helps to kind of finance the next deal that, you end up leaving some money in. But, I mean, the reality of it, all of this is harder right now. It's not like we're in it's not like there's some silver bullet of everything's fine, the market's fine, just keep doing what you're doing. It's like, no, the market's really difficult to work in right now, but it doesn't mean that there aren't deals. So it means that right now you can buy properties for way less than you could a year ago. So that's a huge advantage. So from there, can you make sense of a deal? Can you buy it under current market value? So even less. And, is there a plan to turn units over, get them rented at market rent, and bring it in for a refi? And what does that refi look like? There's some things that have changed and some things that haven't, but difficulty level has changed. Absolutely.
Yep. No, that's definitely true. Seeing all that stuff, seeing properties that, again, they might be losing a few $100 a month, but again, you look at over the long-term play, that's what it is. There's still value add that needs to be done to that. So some other stuff, how the rent caps influence what you're doing.
The rent caps. Sorry, what do you mean?
Like 2% rent cap is what we have. What do you guys are? I think you guys are the same, aren't you?
It's always been the case here. It's we've never expected rents to go up more than 1.2 to 2.5%. We had a year, during COVID, they said nothing. It was 0% that year. So that was terrible because everything else went up, I mean, it wasn't that terrible because property values went up, so that was great. But the reality is cash flow would have dropped during a year like that. So you always want to give the minimum rent increase you can. I mean, that's out of our control. So you need to expect that, when you're buying a 6-unit building, you need to understand that there's a chance half of them don't leave. And that's the max rent increase you'll be able to give them. There are ways to do rent increases above the guideline if you do certain things to the building, and you can talk with a paralegal about that. I'm actually in the process of it on my 24-unit building, because we did a new flat roof, all new electrical. We painted the whole exterior. We've we've increased security, we've made the building safer, we've dealt with all sorts of pest control. Like we've increased, like we've made people's living in that building 10 times better than what it was. You know, they were dealing with, there was drug dealers in the building, whatever, but there's still, you know, 16 out of the 24 units haven't turned over. We've turned 8 of the 24 over so far. We've been focused on other buildings, but it's just like, you know, we turned a whole 8 unit building over in that time, but in the process, 8 of these 24. So, you know, you can sometimes increase above the guideline, but for the most part, you need to plan to not be able to, and instead just deal with cash for keys. And again, with cash for keys, there's no silver bullets. The silver bullet is the cash. So you need to offer them enough that they're going to be willing to leave. The other is actually have that conversation, because most people, well, I don't know how this is going to work. It's like, well, you need to actually try. So start there and offer more money. I mean, those are going to be, that's your 80-20 right there. Like that's the 80% of the value you can, or of what you can do is actually have the conversation and actually offer a decent amount of money. And then wait, you know, sometimes it takes people 3, 4, 6 months before they go, okay, I'll accept it. And they're more likely to accept it in the spring from what I've found. So it's not particularly easy to get cash for keys done during the winter. People don't really want to move in the winter. So there is some kind of psychological benefit to doing that in the spring and summer. So
I've heard some horror stories.
Go ahead, Ian. Oh, I was just going to say, we just did a 8 unit building and cash for keys, all of them in under a year, which it was pretty hectic, but it can certainly work. And then we have another 8 unit building where no one wants to take any of the cash for keys. So that's another thing. And that's, I would say, loosely based on the demographic of the people that were in it. Some people, they've been there for a long time. It was sort of a lower income area and they were just happy there. That's their home. They don't want to move. And we said, that's fine. And then other people that were, you know, working professionals, they were keen to say, yeah, I can just go find another place. And that's what they ended up doing. So.
And you need to make it as easy as possible for them. First off, before I forget, there tends to be an anchor tenant. So, you know, in that 8 unit building, you had pretty decent chance there was 1 or 2 tenants. As soon as you got them out, everyone else came out in a wave. So,
it's crazy you say that. There definitely was.
So it's really important to work on those anchor tenants. Those tend to get the ball rolling. So your other 8 unit building that hasn't happened at that yet, identify who those people are and really try to make it work for them. You know, maybe you have to pay them quite a bit more. But if you can get that ball rolling, then it kind of snowballs from there. So we had the same thing in one of my 8 unit buildings. We got all 8 turned over, and it was again, of course, chaos. You know, you have a period of time where it's vacant, and there's people. I think we had people. I don't know if we had squatters, but we definitely had people trying to break in, and like we had someone rip out a chunk of copper from the boiler, like you know, it was like a $8,000 repair. Like it was crazy, but it's all part of the process. Yeah, that building I was gonna ask, was one of my best burrs actually, and it was,
I was just going to ask, have you ever had to dish out an extraordinary amount for cash for keys? Because I've heard of some Ontario guys, $50K, you know, to get somebody out. Have you ever had to go super high?
It's probably not going to be worth it. The $50K stuff is probably more if someone's trying to turn stuff into condos or whatever. But I mean, when you're talking about that amount of money, it doesn't make sense to do. So it's usually 5 to 10. I've had to do probably like 12 plus, you know, if it's like 12 plus forgive their arrears, you know, you know, or sometimes if they have arrears, then you're best off just enforcing and waiting the 8 months, you know. A lot of times we'll do it where, you know, say we're going to give you $10,000 either way. So, or not either way, but $10,000 is your offer, minus the arrears you owe. So you owe $4,000 right now. So we're going to give you 6 plus forgive your arrears. If you wait an extra month or 2 months, you know, the amount of money we're going to give you is going to drop to $5,000, $4,000. You know, it drops as they wait longer and longer, because by the time it hits the 8 to 10 a month mark, you're just going to go through with an eviction anyway. And it's better to get that done before having to go through the court case and stuff. But it gives them a bit of a ticking clock.
Yep, big time.
Yeah.
Now, you're mostly property managers. Any self-management, or you help out a little bit, or all 100% property managers?
I manage the reno. Like well, my GC manages the renos, but I manage him. So, but in terms of like tenants, no, I don't talk to any of them anymore. And it's been wonderful.
Yeah, I remember on some previous pods, you would say, yeah, we'd go over every now and then and do this and that. And
I honestly, I used to make I used to make the argument for self-management quite a bit, and I think that I made the argument for both sides. So now I'm on this side of it, and I can understand this side better. I self-managed until 52 units.
Yeah, that's
just me. So
I made it to about 8 units, and I was done.
It's more than me. I made it to 2. I said, "This is enough."
Yeah,
but there is value in at least doing it once.
Yes, exactly. And there is, for some people, the value in just hiring it out as soon as they can, like after they've done 1 or 2 themselves, because if it means that you're not buying real estate because you're like, I don't want to buy that building, it's got bad tenants. It's like, well, why don't you look at it instead as an investment, because you're buying an investment property, and then take the emotion out of it and budget for the property manager. And now you're looking at it all again as a numbers game. Yeah. So, I mean, like I said, I self-managed until 52 units. Last year, we were in Costa Rica, probably 14 months ago or something like that. And I was, at that point, I had handed over half my portfolio, and I was in Costa Rica, and we were about to go, we were literally about to go surfing, and I was like getting texts from tenants, and I was like, yeah, no, I'm hiring it all out. So I was like, it's happening.
Yeah, it's a good feeling. And that's it. We were like, man, we can stay on top of the property manager or management. And then one little thing went wrong. And then it was like, here's 6 hours of your time just focusing on like this one little problem. And it was like, oh no. So
yeah, no, exactly. And I don't think a lot of people consider the mental bandwidth aspect to it. That was something Matt McKeever would always talk about. It's become part of my core philosophy. It's just understanding the mental bandwidth of what we're working on. So maybe tenant management only takes a few hours a week, but it's on your mind like all the time, or a ton of the time. So it's nice to not have to think about that at all. I did a story recently on my Instagram because I walk the dog in the neighborhood, and like I own a bunch of buildings in the neighborhood and in the adjacent neighborhoods, and I'll walk by my 24 unit, my 11 units, some triplexes, and none of the tenants know who I am at this point, which is awesome. Whereas they used to be like, oh, Kellan, whatever. And I'm like, no, I'm just up for a walk with my dog. Like, So there are a few tenants. There are still a few tenants who know who I am from when I self-managed, but for the most part, they're all right. So
no, that's great.
Yeah.
No, perfect. So moving on. Yeah. Some of the maybe the failures that you've had or big lessons that you've learned, something that you wish you could go back, tell yourself a while ago, like, hey, this may be a strategy or this may be a way of doing things. Any big points like that stand out to you?
Yeah. So in the earlier days, I used to buy buildings that had like an illegal 3rd unit or an illegal 4th unit or stuff like that. And, like they were always going to be great deals. And I mean, for the most part, if you're doing that, they have to be great deals. But the reality of it is you don't really want to buy a building that you're not pumped to own for the next 20 years. And so that's been now a philosophy of mine. I'm not buying anything that I'm not planning on keeping for 20 years because I'm not a flipper and I don't want to be a flipper. I don't want to make active, active income isn't my number one goal, right? The highest and best use activity for me is long-term buy and holds for long-term wealth. So that means it has to fit that criteria. So that's something that, like, there's a lot of buildings I've bought over the years that I definitely I wasn't particularly pumped to own for 20 years, or at least now I look back and go, so that's what some of the ones that I sold were, which is nice because you can get rid of some of the buildings that I'm not particularly pumped to own and then instead put it into buildings that I am happy to own for a while. So that was one lesson. The other was like the first building, I should have done a purchase plus improvements. So I definitely recommend people doing that. Another was probably over leveraged to some degree. And I'm like nowhere near what most people do, but even for me, it was just a little too far into the leverage side of things. So again, it's no partners and things like that. So you need to figure out ways to finance deals. And if you're borrowing down payments, sometimes you can end up in a situation where it's just, you're like, well, like, again, if the refis aren't coming in the way you want, how do you pay the debt off? And I mean, like, I generally don't have issues borrowing money when I need to, but that's not an answer to the problem. The answer is deleverage. So for me, that means refi whatever I can, get mortgage debt to pay people. And then if there's opportunities where I have buildings that have $200,000-300,000 in equity or something that I'll just sell that place and pay off a bunch of loans like that. So I would say that was definitely a lesson from this whole market situation, right? Is like, my portfolio was cash flowing like crazy and now it's not. So that's another lesson I've sort of learned is like, you can't actually particularly expect to live off cash flow from your buildings. And I've sort of known that for some years. The reality is most investors are sort of living off refinance funds because properties are, maybe it cash flow this month, but not the next. And I mean, it's also quite difficult to build a portfolio that cash flows 20 grand a month. I mean, at one point I did have, mine was cash flowing 17 a month, but when you end up hiring out management and things like that, and then the rates go up, it zaps like most, if not all the cash flow. So, again, you have refinance funds, you have a ton of capital in the bank and that's fine. But you'd ideally have some kind of monthly income so that things make sense month to month. I think that like, as much as I say that's a lesson, there probably are two ways to look at it. Some of the most experienced investors I know are actually perfectly fine with a neutral, if not even somewhat negative month to month cash flow because they understand the long-term play. So if you lose, say your whole portfolio, you lose $5,000 a month. Let's say that's 60 grand a year. It sucks for sure, but 60 grand a year, you can have that capital in the bank to deal with that burn rate. And then over that year, on average, your portfolio might might appreciate by 3%. And if you have a $10 million portfolio, you get $300,000 a year of appreciation on average. So actually the numbers kind of do work out in the long run, but I like to try to make sense of things both month to month and in the long run. So for me, that's sort of the sleep at night factor.
You'd have to have the capital in the bank or some sort of active income to be able to eat that, because it does. You're right. It makes perfect sense to do so. Like not only the appreciation, but the principal pay down. You'll make a killing no matter what.
Exactly.
But you have to be able to withstand that month to month burn rate, because if you can't, it gets tight.
Yes. Yeah. No, exactly. And the solution most people have is I'll just borrow more money. It's like, that's not a solution. So
that's not a solution at all. No.
Yeah, that gets
honestly, I think to some degree it should be a red flag for people if they constantly see people just raising money. It's like, are they making money? Like, show how you're making money. What are the deals you're doing that are at, like, what do they look like? Like, are you making millions of dollars because you're borrowing millions of dollars? Yeah.
So I agree, and if you are someone that's considering loaning your money out, you should vet the person very carefully and very much understand what they're using that money for and when you're going to get your money back. Because, they may tell you one thing, but if they take that capital and go do something else with it, that promissory note, it's not that great. It's not
exactly. And I do lots of prom notes, and anyone who loans me money, I say, look, like, you're going to be happy with how it goes. And I've paid out tons of money to people over the years, but I go, just be careful what you do with that money now. Like, don't just go feel like it went well with me and that's cool, but like, don't just go lending it out to the next Joe Blow because you might not get it back. Like, we've seen situations like that locally. Millions of dollars is gone. So
absolutely. Yep. And it's so easy to just do that spreadsheet magic. Like, this is where your money's going. And, we just got to do this reno here, that reno there, and away we go. But it's like, at the end of the day, especially if it's someone that's scaled quite quickly, it's like, nope, that's going down to the property down the street that's behind on this and behind on that. So it's,
I would say prom note debt, you need to trust the person you're loaning to, like, completely. Because they may just, like, if they can't pay you back, it's essentially you're not going to get the money. So you need to completely trust them, and trust in two ways. Trust not only that they have the best intentions, but trust in their ability to invest competently. Because you can trust that someone has the best interest in mind, but they might suck at what they do, or vice versa. They might be really good at what they do, but they don't have your best interest in mind. So you need to trust them in both ways.
Yeah.
So for the most part, I would honestly avoid too much in terms of the prom note side of things. Secured loans are a lot, to some degree safer. Second position is, not particularly exciting, but if you can do first position loans, like if you have hundreds of thousands, then a first position loan, quite a reasonably safe thing to do.
This actually brings me to my next question, Kellan. So you own everything by yourself. Talking about private money, have you ever considered just giving equity out, or like as you continue on? If no, you don't want to, you like the full control?
Yeah, no, I have zero interest in that, zero. So I should clarify. I have thought about it. All of these things I've thought about. I talk a lot about focus over the years, and ironically, I have ADHD, like an actual diagnosis for ADHD. Yeah. And so like it's a concerted effort for me to maintain focus because I see all of these distractions out there. And actually almost all of them I've done deep dives into and decided if it was for me, because that's the only way that I can really make a decision. So Airbnb, I learned almost everything about it and then decided not for me. Furnished rentals, everything about it, decided not for me. Wholesaling, I've done a little bit of wholesaling, but that's more of like a buy the best, wholesale the rest. Like I know enough people. If I got something under contract with an assignability clause, it's easy enough to just pass the papers along for a fee. But it's not my focus. Mm-hmm. Flips, same idea. I think flips is a little bit one that you, for the most part, you should put off until you've built a significant portfolio, and then at that point, if you want to take on flips for active income, nothing wrong with that. But the only way that I've been able to be able to maintain focus for me was to actually learn a decent amount about each of those things and then decide if it was for me or not. And to this day, it's just buy and hold, burring in the same city. I'm starting to open my eyes up to other cities, consider other cities, but even for now, still, it's been the same city. I don't think everyone needs to be that focused, but it's just me trying to, it's not my intention, but it is kind of setting an example as to, how I think people should try to maintain focus. It's actually been so cool because I've been talking about that for years, and now Alex Hormozy talks about it constantly, and I'm like, yes, and he says it's so much better than me too. Yes, focus.
Yeah, 100%. No, that's great. So, what's next?
So, right now I'm doing coaching and stuff. So that's actually my active income source as well right now. So I have a mentorship program. I'm doing that. I do 6 months just teaching people what I do and what I've done. So if people are trying to, build passive income, build a portfolio, focus on burring, do it in a safe way, and they're not just in it for the hype and stuff. They actually have intentions to do this over a long period of time. I have that option available. So I'm doing the coaching. My two highest value activities right now, my number one highest value activity is focusing on my portfolio and restabilizing things, and not just stabilizing, but optimizing the portfolio. But the reality of it is that only takes so much of my time. You only need to send a few emails and stare at your spreadsheets for a period of time before you go, this is the plan. And then I'd like to keep busy in the otherwise. So so that's what the coaching is for. It's an active source to go with the passive stuff. So those are my two highest value activities in terms of the income side of things. And then otherwise, now I'm finally going to the gym 3 days a week, and I'm doing a little bit of running, and we've been doing a ton of traveling. Last year we did Norway, Australia. We did Norway for 3 weeks, Australia for a month, New Zealand for 2 weeks, Costa Rica. We did a 1 month trip to the East Coast of Canada. It was just an absurd amount of travel last year. So
it's so crazy to hear that too, because listening to the last podcast, it was hey, what things do you want to do? And then now I get to hear you say those are the things that I just finished doing. So that's cool. Congrats on that. That's huge.
Thank you.
Yeah.
Thank you.
Yeah.
So I've to this day, I've been saying this for years. I've actually never been super clear on what the future holds for me. I've never been one to really make 5-year plan, but I do sort of have a 20-year plan. For me, I've moved from the smaller multifamily into the larger multifamily this last while. And so that goes with my 20-year plan, which I've never really had before, but now it's sort of I understand I want to buy buildings that I'm happy to own for 20 years. I generally want them to be 6+ units because those tend to be easier for me they're less mental bandwidth, first of all, to own fewer, bigger buildings. And they tend to just scale the numbers well. I have more assets under management, more mortgage pay down, more potential for long-term appreciation. So continue scaling the portfolio with 6+ unit buildings, and otherwise enjoy life.
Yeah, no, fair enough.
That's the dream. That's great.
Thank you.
Well, listen, yeah, we want to just thank you so much for coming on, joining us today, but also all the content you've put out in the past. Again, it really does make a difference. Yeah, I'm sure like we said before, you can't even fully appreciate like how much it actually does help people out. But just want to confirm that yes, it very much so is helping people out. So on that note, too,
Thank you, I appreciate it.
Yeah, if you could share where people could learn more about you.
Yeah, on Instagram, Kellan.James, and my website, kellanjames.ca. That's where everything can be found at this point.
Yeah.
I should get into more doing shorts and stuff, so I should get on TikTok, YouTube Shorts, all that stuff. Maybe I will. It's kind of on the list.
Man, so TikTok's hard, man. I try. I'm a dud on there.
Really?
Yeah. There's the clientele. You know, it's the teenage kids. They're not that into real estate yet.
Maybe.
But they will be.
I don't think it needs to be an effort specifically for TikTok. I mean, for the most part, a lot of this content's recyclable. So the reality of it is, I take this podcast, take shorts out of it, post them on all platforms. So yeah, so I need to have someone on my team, because at this point it's still me, my property manager, and my GC, but I should have someone else handling some of that stuff for me and kind of chopping things up, reposting it, that kind of thing. So I guess that should be something I should be looking at.
Well, all right. No, again, we appreciate you coming on the show, and we will certainly be watching for all the big things in your future. And we'll stay in touch.
Thanks, guys. Appreciate it, guys.
Alrighty.
Thanks for having me.
Thanks, Kellan.
Cheers.